You probably think modern finance was invented on Wall Street with computers and complex algorithms. You think of high-speed trading, derivatives, and global markets that move at the speed of light. But what if I told you the entire operating system for global capitalism, from holding companies and sovereign bonds to insurance and double-entry bookkeeping, wasn't invented in the 20th century, or even the 19th? It was invented in the 14th century by merchants in Florence, Venice, and Genoa who were trying to solve three problems: how to fight endless wars, how to trade across the world, and how to make a profit without getting excommunicated by the Pope. This is the lore of money. We explore how money shapes history, power, and society. Subscribe for more. Before we trace the evolution, you need to understand why monetary systems change at all. Systems don't evolve randomly. They change when there is a massive expansion in trade that breaks the old tools, when states are locked in existential warfare that demands constant funding, or when powerful ideas place constraints on what is morally or legally possible. The Italian city-states of the late Middle Ages had all three pressures at once. The reopening of Mediterranean trade created enormous wealth and complexity. Constant warfare between these republics created a desperate need for state financing. And the Catholic Church's absolute ban on charging interest created a powerful intellectual obstacle. This was the crucible where financial innovation wasn't just an advantage, it was the only path to survival. Let's start at the beginning, with the problems of the individual merchant. The commercial revolution of the Middle Ages created a set of brand new problems. 1,000 years before, a merchant was a traveler who moved with his goods and his gold. Now, he was becoming a sedentary manager, running a global network from a central office. This new reality created three huge obstacles. The first was distance. How does a wool merchant in Florence pay a supplier in London without physically shipping chests of gold and silver? Transporting bullion was not only slow and expensive, it was suicidal. Archives show that even a state official like Geoffrey Chaucer was robbed 3 separate times while transporting government funds in the 14th century. The solution was the Italian invention of the lettera di cambio, or the bill of exchange. This was not a simple check. It was a brilliant 4-party instrument that solved 3 problems at once: funds transfer, currency exchange, and credit. Here's how it worked. A merchant in Florence who needs to pay for English wool goes to a Florentine banker, like the Medici. He gives his florins to the banker. The banker then writes a letter, the bill of exchange, addressed to his own agent in London. This letter orders the London agent to pay the wool seller a specific amount in pounds sterling. The wool seller presents the letter and gets paid in his local currency. In one move, value crossed a continent without a single coin ever being at risk. But the real genius was in the timing. The bill wasn't payable immediately. It was payable at usance, a set time in the future, like 90 days, which was roughly the time it took to travel between the two cities. This 90-day period was effectively an interest-free loan, allowing the merchant to finance his trade. The banker made his profit by hiding it in the exchange rate, a crucial trick we'll return to. The second obstacle was physical risk. Long-distance sea trade was incredibly profitable, but a single storm or pirate attack could wipe out a merchant's entire fortune. To make global trade viable, this catastrophic risk had to be managed. The Genoese, in particular, responded by inventing the world's first market for maritime insurance. This was a legal and theological minefield. Charging a premium to insure a principal looked suspiciously like a loan that was only repaid if something went wrong, and any profit from it could be condemned as usury. So, the early insurance contracts were disguised as other transactions. The first disguise was a fictitious sea loan. An insurer would provide a loan to the merchant for the value of his cargo. This loan only had to be repaid, with very high interest, if the shipment arrived safely. If the ship sank, the loan was completely forgiven. That high interest was, in fact, the insurance premium, hidden in plain sight. By the 15th century, these legal fictions were dropped, and modern insurance contracts were born. The third and final obstacle for the sedentary merchant was information. How could you possibly track dozens of cross-border transactions, assets in transit, liabilities from bills of exchange, and the profits of different ventures all at the same time? The answer was double-entry bookkeeping, the true language of capitalism. This system, perfected in Venice, was a radical departure from simply logging money in and money out. The core principle was that every transaction had to be recorded twice, once as a debit in one account and once as a credit in another. A sale of wool wasn't just money in. It was a debit to the cash account and a credit to the wool inventory account. The genius of this was that the system was self-balancing. At any moment, the sum of all debits had to equal the sum of all credits. For the first time, a merchant could see a complete analytical picture of his entire business. He could distinguish cash flow from profitability and track exactly what he owned versus what he owed. This system was used by Italian merchants for over a century before it was formally written down in 1494 by a Franciscan friar named Luca Pacioli. He didn't invent it. He just described what the merchants of Venice were already doing. His book, printed on the new printing press, became one of the most influential works in history, standardizing double-entry bookkeeping as the universal grammar of commerce, a status it holds to this day. These three innovations, the bill of exchange, maritime insurance, and double-entry accounting, formed an interdependent system. A merchant in Florence could now finance a shipment of wool from London, insure it against loss with a Genoese underwriter, and manage the entire venture from his desk, all while knowing his exact financial position. But all of this existed under a dark cloud. The single greatest intellectual and moral constraint of the medieval world, the Catholic Church's absolute prohibition of usury. To innovate, the merchant bankers had to navigate not just economics, but theology. In the medieval period, usury didn't mean charging excessive interest. It meant charging any interest at all. The doctrine was absolute. Whatever exceeds the principle is usury. This was a mortal sin, punishable by excommunication. The great theologian St. Thomas Aquinas argued that money was a consumable good, like food or wine. You can't charge someone for a bottle of wine and then charge them a separate fee for drinking it. In the same way, you couldn't charge for the return of money, the principal, and also charge for its use, the interest. It was, in his view, selling something that does not exist. A more poetic argument was that the usurer sells time, which belongs only to God. This doctrine created an impossible barrier for commercial enterprise. In response, theologians and bankers began to engineer sophisticated workarounds. Theologians argued that while charging for the loan itself was a sin, a lender could demand compensation for extrinsic titles, reasons external to the loan. The most revolutionary of these was lucrum cessans, or lost profit. This was a claim for compensation based on the profit the lender would have made if he had invested the money himself instead of lending it out. This was, in effect, the world's first formal articulation of opportunity cost. Early thinkers like Aquinas rejected this idea, arguing future profits were uncertain. But later, theologians living in the bustling commercial world of 15th century Florence saw that capital was not sterile. It had a clear and measurable earning potential. Their acceptance of lucrum cessans was the theological permission slip that commerce desperately needed. The bankers, however, didn't wait for permission. They engaged in brilliant financial engineering to create instruments that were legally and theologically not loans, and therefore not subject to the usury ban. The bill of exchange was the primary tool. The profit a banker made wasn't called interest. It was disguised within the currency exchange rate. The rate for a 90-day bill was simply different from the spot rate, and that difference was the banker's risk-free profit. For domestic lending, where the currency exchange trick wouldn't work, they invented the contractum triennius, or triple contract. This masterpiece of structured finance combined three individually legal contracts into a single package that functioned exactly like a loan. First, the capitalist would invest his money in a partnership with a merchant. Second, he would buy an insurance policy from that same merchant against any loss of his capital. Third, he would sell his right to any potential profits from the partnership back to the merchant for a fixed fee. The result? The merchant got his capital and the capitalist got a guaranteed risk-free return. It was a loan in everything but name. The usury doctrine, meant to stifle finance, instead acted as a catalyst for sophistication. It forced bankers to invent the abstract, structured financial products that define the modern world. While these tools were available to many, it was the great Florentine banking houses that scaled them into global empires. The first giants of the 14th century were the Bardi and Peruzzi families. These were the world's first multinational corporations, so powerful they were called super companies. They had branches from England to the Middle East and were the primary bankers to kings and popes. But their structure was their fatal flaw. They were centralized, monolithic companies. All branches were part of one single legal entity run by salaried employees. This created massive systemic risk. Both firms made the fatal mistake of lending enormous sums to King Edward III of England to finance the Hundred Years' War. When Edward defaulted in the 1340s, the loss didn't just bankrupt the London branches. It caused a catastrophic domino effect, collapsing the entire global network. This was medieval Europe's first too-big-to-fail crisis, and it plunged Florence into a depression for a generation. Rising from the ashes of this disaster was the Medici Bank. Founded in 1397, the Medici learned the critical lesson of the Bardi and Peruzzi collapse. Centralized risk is fatal. They pioneered a revolutionary decentralized structure, a direct ancestor of the modern holding company. The Medici Bank was not one company. It was a network of legally separate partnerships. The Florence headquarters acted as the senior partner, but each branch in Rome, Venice, or London was its own distinct legal entity with its own capital and its own books. Crucially, the branch managers were not salaried employees. They were junior partners who had to invest their own money into the branch and, in return, received a share of the profits. This brilliant model solved the principal-agent problem centuries before it was formally defined. It gave every manager skin in the game. But its primary genius was risk isolation. The partnerships were designed to be watertight compartments. The failure of one branch could not bring down the entire network. When the Medici's London branch later failed after making bad loans to another English king, it was liquidated on its own. The holding company and the other profitable branches were legally and financially insulated from the disaster and continued to operate. This structure was so robust that the bank's eventual decline in the late 15th century wasn't caused by a financial crisis, but by political entanglement, as its leaders began to treat the bank less like a business and more like a personal treasury to fund their political ambitions. The same pressures of survival that transformed private commerce also revolutionized public finance. The constant existential warfare between the city-states was ruinously expensive. To survive, they were forced to invent the world's first markets for government debt, but each republic engineered a different solution. By the mid-12th century, Venice was broke. Its solution was the prestiti, or forced loans. The government compelled its wealthiest citizens to lend it money. In 1262, the state took a revolutionary step. It consolidated all these messy individual loans into a single permanent fund called the Monte Vecchio, or the Old Fund. This was the world's first permanent national debt. The state did not promise to repay the principal. Instead, it earmarked specific tax revenues to make regular semi-annual interest payments to the bondholders forever. But the true genius was that the government declared these shares to be freely negotiable. This created a vibrant secondary market for government debt. A citizen who had been forced to lend to the state now held a liquid asset he could sell to any other investor. This masterstroke turned an oppressive tax into a tradable financial instrument, creating political tolerance for levels of state debt that would have been unthinkable otherwise. Florence followed a similar path, consolidating its forced loans into a public fund called the Monte Comune. But Florence's unique innovation was the Monte delle Doti, or the Dowry Fund, established in 1425. This was one of history's first state-run investment schemes, designed to solve a crucial social problem. In Renaissance Florence, a large dowry was essential for a father to marry off his daughters. The Dowry Fund allowed a father to deposit a small sum for his young daughter. The state then guaranteed a very high compounded rate of return, paid out as a massive dowry when the girl came of age 15 years later. This was, in essence, a state-issued zero-coupon bond combined with a life insurance program. It was wildly popular, providing a new stream of voluntary capital for the state, while serving a deep social need. Genoa's solution was the most radical of all. In 1407, facing its own fiscal crisis, the Republic consolidated its public debt. But instead of managing the debt itself, it ceded control to its creditors. It created the Bank of St. George, an autonomous private corporation made up of the state's bondholders. This new entity was given unprecedented powers, effectively becoming a state within a state. It was granted the right to collect most of the government's taxes to ensure interest payments to its members. As the state's debts mounted, It literally handed over governance of its colonial empire, including Corsica, to the bank as collateral. The Bank of St. George became the world's first independent public bank, a private institution that managed public debt, collected taxes, and governed territories, all while functioning as a commercial bank. The political power of the Italian city-states faded in the 16th century, as the center of gravity of the world shifted from the Mediterranean to the Atlantic. But as their dominance declined, their financial technology was exported north, where it became the foundation for the next wave of global economic power. The rising nations of Northern Europe didn't need to reinvent finance. They simply imported the Italian model. The famed Bank of Amsterdam, a pillar of the Dutch Golden Age, was a direct copy of the public Giro banks of Venice, which had perfected the system of making payments through dematerialized book entries. The establishment of the Bank of England in 1694, often seen as the start of England's financial revolution, was modeled directly on Genoa's Bank of St. George, a private joint stock company created to lend money to the government and manage the national debt. From the bill of exchange to the sovereign bond market, from maritime insurance to the holding company, from double-entry bookkeeping to the very concept of opportunity cost. The entire architecture of modern finance was designed and stress-tested in 14th and 15th century Italy. Every transformation seemed impossible before it happened. A world where value could cross continents without physical money, where risk could be bought and sold, where a state's debt could become a citizen's asset. Each time people thought the old system was bedrock. They were wrong every time. So what's the next transformation? The financial system we have today is facing its own pressures. The rise of digital currencies, the challenge of unsustainable sovereign debt, and the new intellectual constraints of a multipolar world. One thing history makes clear: the system we have now will not last forever. Nothing ever does. The question isn't whether money will evolve again. The question is whether you'll understand the change before it happens or after. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.